Okay, let's get back to that breaking news. The Bank of Canada once again cutting interest rates. Now, in recent trading sessions, there was growing buzz that our central bank might follow through on another rate cut. Remember, in their June meeting, the Bank of Canada officially pivoted after a big run-up in interest rates. Since then, we've seen some encouraging trends in the fight against inflation, but we have also increasingly seen some signs of a weaker Canadian consumer. Retail sales data recently pointed to that. And the Bank of Canada today increasingly focusing on the potential downside risks for the economy, not to mention a wave of mortgage renewals we're going to be watching over the next couple of years as considerations for the path going forward. Their language still somewhat cautious when it comes to being fully committed to cutting interest rates at a rapid clip. But I do want to get some instant reaction to all of this. Joining us here in studio this morning, David Wolf, portfolio manager at Fidelity Investments, former Bank of Canada advisor. Christine Tan is with us as well, portfolio manager at SLGI Asset Management, with more on the broader market reaction. And on the bond side, Earl Davis, head of fixed income and money markets at BMO Global Asset Management, back with us again as well. Always great to see all of you. Thanks very much for joining us.
Good morning.
David, let me start with you. So I think that those who really follow the markets might not be too surprised, because there was a growing expectation the bank would cut again today. But with the cut and the language around the decision, what was your takeaway?
So to your point, there's news here. There's news for borrowers, clearly. There's not much news for the markets. It was an expected move, and I think folks were generally anticipating that we would have dovish comments sort of setting up the possibility, not the certainty, as you mentioned, but the possibility of or the likelihood of further cuts. I mean, it's a general situation where you have the economy weaker, you have inflation coming better under control, and we know that unlike in the U.S., this economy is not going to fare well if interest rates stay anywhere close to current levels, given the wave of mortgage renewals coming up over the next couple of years. So rates have to come down. Inflation is permitting them to come down, and they'll probably come down further in the future.
And Earl Davis, I think throughout this central bank cycle where a lot of central banks around the world were blamed for not being faster in the fight against inflation. Once they did enter the interest rate hiking cycle, the immediate question was, can they get the math right to ensure that the economies can handle higher interest rates? Can you orchestrate a so-called soft landing? Does today feel like a moment where, if inflation trends are good enough for the Bank of Canada, that now the attention is more on trying to ensure that they have a soft landing for the economy?
So I do think that's the intent. It's a hard question in regards to inflation, because it's not about short-term inflation, it's about long-term inflation. Where is that base? So they have to keep an eye out on there. Having said that, I do believe they are making the right moves on the short and medium economic data that we're getting out. The big thing here is twofold from the Bank of Canada. There was one little surprise to me. Now I think for sure we're going to get another 50 basis points of eases this year, 4% by the end of the year. I think there's a possibility we get to 375 here. Yeah.
Because?
Oh, and that's because of disposable income. So that mortgage renewal window, when you were talking about, that means individuals, a significant portion of mortgages are rolling over the next couple of years. When they pay higher amounts on their mortgage, they have less to spend. The individuals that are buying houses, let's call it middle class, upper middle class, that is your cohort that spends the most of their disposable income. With less disposable income, less spending, and we saw that in the last numbers, and that's in the Bank of Canada's mind, because when they lower interest rates, the variable rate, your rate on your credit card decreases, your adjustable rates on your mortgage decreases, more disposable income to help the economy keep going.
Right, they do seem to be talking about that renewal risk impacting consumption. Broadly speaking, we saw that in some of the survey data recently. And Christine, something else that came out recently in some of the Bank of Canada survey data around businesses was that they were anticipating that wage growth would not be as robust going forward. We already have an unemployment rate that's north of 6% in this country. Obviously, the pace of job growth has not kept pace with the population growth itself. And so the wage growth story is also being pointed to by the Bank of Canada today. I would imagine that does not surprise you.
No, doesn't surprise us at all. And if you look at the recent wage inflation, a big part of that comes from the public sector as well. So it's not really broadly spread out. And to your point, and the Bank of Canada has talked about this population growth, the availability of, let's call it labor, has been far in excess of the actual jobs that are available. So not a surprise. If you look at the most recent consumer expectations survey as well, the main things that's being cited as reasons why wages are staying a bit sticky or expectations are sticky are government spending levels and housing prices, which is kind of indirectly linked to interest rates itself as well.
The Canadian dollar, in reaction to this news, David Wolf, we did see weakness against the American currency, but I'm not sure we would call this a dramatic weakening in the currency, and maybe that's because people in the markets were increasingly anticipating this. But I do think, and just building on what Earl was projecting in terms of the possibility path forward for rate cuts in this country, there's been a lot of narrative around the divergence with the U.S. How big a divergence we might see, at what point is the Bank of Canada less comfortable with that divergence, and how does that impact things like the Canadian dollar? Where do you sit on that right now?
Sure. So first of all, in terms of today's price action, as you mentioned, Canadian dollar is down a little bit, but it's basically unchanged since the announcement, which indicates that folks in the markets are not surprised at either what they did or what they said. The general grind lower in the Canadian dollar over the past, call it 6 weeks, I think has been markets generally adjusting to the fact that, yes, the bank can cut rates at a faster rate than the Fed can. Markets are not anticipating that much further divergence. So if you look at the forward interest rate curves, and I'll defer to the fixed income expert to make sure I'm on point on this, but market is pricing 2 or 3 more cuts in Canada. And the beginning of a Fed easing cycle, there's also 2 or 3 more cuts. So that's basically moving in lockstep, no divergence. But the current, as of I guess 25 minutes ago, the current gap between U.S. Fed funds and the Canadian overnight rate is 87.5 basis points. We've seen that get as wide as 200 to 250 basis points over the last couple of decades. And I think if you ever had a situation to restore that very wide divergence, it's today, because the U.S., a lot of fixed rate debt, a lot of long-term debt, and debt has come down. In Canada, a lot more debt and a lot shorter debt, particularly variable rate mortgages, 5 years. So if you ever had a situation where Canada should have much lower rates than the U.S., it's now, and I think we're going to see more of that, and the Canadian dollar is going to reflect that.
Okay, that's helpful. And Earl, let me come back to you specifically on bond market pricing right now, because we were having a conversation with another economist, David Doyle, this week, who said, you know, yes, let's see what the Bank of Canada does with rates. But in the mortgage market, you're pricing off of where bond levels are. Like you're pricing off of, let's say, the 5-year yield for Canadian bonds right now. And it's not like when they cut interest rates for the first time in June, we saw a flood of people. There was this, this narrative out there that people might be racing into the housing. We didn't quite see it. Doyle's argument was that that's a good thing for the Bank of Canada, that they were able to cut rates, that because things don't change that dramatically for the average consumer or home shopper as a result of that, it leaves the door open for them to potentially move down this path and not have to deal with that other issue. The irony of housing inflation continues to be a challenge because interest rates are up, and that's changed the dynamics in the rental market. So how do you think about that part of the equation?
I actually take the other side of that. I do think the Bank of Canada would like to see more easing discounted in the market, because it's not their rate, the overnight rate, that impacts your 5-year mortgage rates. It's what's the market discounts. So I think they help themselves today by saying the risks are skewed to the downside. What that says in easing talk is there's going to be more eases that are being discounted in the market today.
You're trying to needle the market a little bit?
Yes, exactly. So I do think they'd like the market to discount it, just because, to me, this disposable income perspective is a new perspective, but it's very important, and it's the other side of the coin of renewals. So what happens when they reduce the overnight rate, and let's say the overnight rate goes down 25 basis points, 5-year mortgage rate maybe only go down 5 or 10, but your 3-year rate, your 2-year rate goes down even more. It gives people options now.
Right.